Yo, what is up? It's the Cosmic here.
Pick it up, pick it up, pick it up, pick it up. You see the drippy, I'm fitted up. Hop in my car and the giddy up. Secure the bag, yeah, I get the bus. Pick it up, pick it up, pick it up.
Welcome everybody to the Anonymous Traders StockCast. Today we are going over the Trading 101's options. This is going to be the first course in this video series, and today we are going to be covering the basics. So without further ado, let's get into it. What in the hell is an option? Options are financial instruments that are derivatives based on the value of underlying securities such as stocks. An options contract offers the buyer the opportunity to buy or sell, depending on the type of contract that they hold, the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they choose not to. And this is comes from Investopedia. So anything that I have question stock related, I look up on Investopedia. And we will go a little bit more into why you don't have to buy and sell this here in a bit. So what are the main components of an option? Well, there are three main components that you must know before you even place a trade, and as they really do affect the price of the option. The first one is the strike price. This price is the price that the holder believes the stock will reach. The closer the stock price is to the actual strike, the more valuable the option will be. Next is the expiration date. This is the given time frame set that the holder will give for the stock to reach that certain strike price. Once the date is passed, the option will no longer exist and it will fade off into oblivion. If this is saying if you are holding a stock and the option expires, then you're just losing your option premium. And we'll get more into detail here in a bit. Next is the options multiplier. This is really important because this tells you how much you actually have to pay for the option. So for the options multiplier, you multiply the options cost by 100 to get the option value and or premium. And sorry for that little typo there. So essentially, if you have an option that's 50 cents per option share, then you have to multiply that by 100 to get that contract value. So that 50 cent option price times 100 is a 50 cent option value per option contract. Next, we're going to go over the different types of options. And since these are the basics, we're going to go only over two main options, and those are calls and puts. A call option, it gives the holder the right to buy an asset at the set price before the set date. So it gives the holder the right to buy this asset at a strike price before the expiration date. And a put option gives the holder the right to sell an asset at the strike price before the expiration date. Now, before I go any further, I'm going to be throwing out a few option lingos. And the main thing that you need to know is how to convey the value of your option. And that is in the money, at the money, or out of the money. So for calls, in the money, your option is above the stock price of your option is above the set strike price. At the money, the stock price of your option is close to your strike price. And out of the money, it is below your strike price. And as for puts, it in the money is whenever your stock price of your option is below the set strike price. At the money if it is close, and out of the money is if your stock option price is above the set strike price. So when buying options, whenever you go to buy options, there are 5 key details to really consider. The one option contract gives you the right to buy or sell 100 shares of that stock at the strike price before the expiration date. When buying an option, your max risk is your total bet. It's just like buying stocks, but a little bit better because it helps you mitigate your risk a little bit easier, and I'll show you that in our examples. Know what your option premium is. You cannot place a trade without knowing what you're paying. That's just going to end up to a road of destruction. So the option premium is the option price times 100. Treat options like stocks. Trade the ones that have high volume and open interest. And I'll show you the how you can find the volume open interest in our examples. But options are just stocks. It's giving you the right to buy a stock, and you can actually make more money on option plays versus regular stock plays, and I'll show you that in our examples again. And lastly, you will almost never need to exercise an option. This means you actually buy those 100 shares of that option. You actually exercise your right to buy or sell those stocks at that strike price. Instead, it is best to trade the options like you would stocks. Buy your option. Once your option becomes valuable, sell your option. You don't need to buy an option, exercise it, and then sell those shares of stocks. You'll actually end up losing money that way. So here we're going to go for an example, and for our first example, I actually pulled it from Investopedia, and our next examples, I'll show you my options trades. So with Microsoft, suppose that Microsoft shares are trading at $108 per share, and you believe that they're going to increase in value. So you decide to buy a call option to benefit from an increase in the stock price. Makes sense. You want a call option if you think the price is going up, because this gives you a bullish sentiment. You purchase one call option at the strike price of $115 for 1 month, which is your expiration date, in the future. And that means that will give you a 37-cent per contract cost. So your total value to buy this option is $37 to have this position, plus your broker's fees and your commissions. So we get that price by your option price, your 37 cents per contract, multiply it by 100, you get $37. So this is giving you, this $37 is giving you the right to buy 100 shares of Microsoft at 115 bucks. So let's continue. If the stock rises to $116, your option will be worth $1, because the option is worth how much more the stock is above your strike price. So since you could exercise the option to require the stock at $115 per share and immediately resell it for $116 per share, you would make $1 per share. The profit on the option position would be 170.3%, since you paid 37 cents and you earned $1, which is way higher than the 77.4% move when it went from $108 to $116. And that's why I'm saying options can be more valuable if you know the trends of these stocks. If you think, like right now, I'll go in this example in a second, but right now I'm in a stock that I believe is going to be $3 before August 21st. Right now it's at $2.40. I'm making money on that option already, even though my strike price is $3. And like I said, I will show you that more here in a second. So continuing this example, the dollar terms would be a net of 63 bucks or 63 cents or $63 that you would make off that option trade. But if your stock fell to $100 and you kept holding your option till expiration, and that's what options you will ideally want to do if you're in a losing options position. If you don't sell it to go ahead and save some of your profits, it'll just expire and you're only out that $37 premium. But the upside is that you didn't buy 100 shares at $108. I mean, that's a lot of money. which would have only been, and if you would have lost that, that would have been an $8 per share loss, or $800 total loss. So taking this option play, instead of buying the shares outright, you're buying the right to buy these shares. And these option plays can help you limit your downside risk. You're still going to make money. If you're right, you're going to make exponentially more money than you did before. As you can see in this last slide, you're making 170.3% off your option trade, whether you would have only made 7.4% off the straight stock trade. To me, that's quick maths. That's telling me, hey, this is way more profitable than just trading stocks. And if I can identify the trends in the stocks, well then why can't I play options the same way I play stocks and be more profitable off of it? And you definitely can. All right, so we now will go to some examples here in E-Trade. So this is how I have my options window set up. I have another window. This is straight up for my stock trading, but I might go ahead and just start using this one instead. I have my candlestick chart on my 5-minute Heikin-Ashi chart, my level 2, my watch list, my open positions, and then this right here is my option order. So let's kind of break this down and look at what's going on here, and let's link this so we can have Mark populate. So my position currently is I took an August 21st, 2020 call position at $3. It has a bid and ask, a spread, just like a stock does, your last trade, your theoretical value, your percent change on the day, your volume, which you're looking for the high hundreds in volumes on option trades. You're not looking for the thousands or millions like you are on stock trades. And open interest. This is how many people are really looking at this option, and that is a good number to have. So I honestly blindly got into this. I was like, you know what? I believe Mark is going to blow its earnings out of the water. I already have a share position of them of $676, or 676 shares. And so I was like, let's see what would happen. Let me buy one option. So the option cost was 50 cents times 100, $50. So I spent $50 on this Mark option, and you can see right here my market value now is $52.50. I just made money off buying this option just because Mark went up a little bit. Now, with that being said, I will make even more money once it hits $3. I will start seeing percent change that's going to be greater than the one that Mark did. And actually, if I will go here into columns and kind of give you that. So percent change overall. Okay. So with Mark, you don't really get a whole lot of percent change. For some reason, it's not populating. It's bid and ask. Right here, it shows 3%, 3.4% that it's changed on the day, and this option was 2.8%. So yes, if you bought Mark fully at the open and held it, then you would be up 3.8%, while I'm up 2.8%. On Mark's option. But whenever it gets to 3, like I showed you in the Microsoft example, if it hits $3 and then 1, my option becomes $1. If it hits $4, my option should become $1 more than what I paid for, and plus the premium that my call has to be able to be bought until August will make this option more valuable in the long run. So whenever you want to go and buy an option, you have to take in consideration how many contracts you want, what kind do you want, a call or a put, the expiration date. So what I like to do is I like to just kind of cruise around the expiration dates, kind of see what's going on. So October 16th, 2020, $4 option call is 10-cent spread. So 60 cents, it's going to say that the last trade is. I'll probably be getting in on this, if not a $5 option call for October 16th, 2020. The open interest isn't really there. The total volume is not even really there for the October option calls. And then you look here at the January's, and it has a lot of open interest, but it doesn't have a whole lot of trades. Just because the further you go out, the more expensive the option will become, and two, there's a little bit more uncertainty on what the stock will do. So let's look at this month, for example. This option at 250, it's not even at 250 yet, but you see it's only 40 cents. Well, Mark is actually at 240 right now, and the $1 strike option is $1.40. So if this goes to $3, then this will become a 90 cent, theoretically a 90 cent option to actually be able to buy. And it will become more valuable as it gives people the right to buy it before July 17th, 2020. So my other option calls I have is in FLIR. I have the August 21st just because July 17th is a little too soon. I have a $45 strike and a $50 strike, and if you see that these are blacked out, that's showing you that I have open positions there. My $45 strike actually kind of did okay. I bought it at the ask, which don't ever buy something at the ask. I was just getting in a hurry, and I'm only a penny down on this option, but as FLIR continues to climb, let's get this populated again. As FLIR continues to climb, you'll start to see that this is a better theoretical option play for me to get into, just because FLIR only does like maybe $1 move on the day max. Look, from 625, it went $5 from 625 from the first. So within the 2 trading days, it's increased from 40 to 42, so $2. That's like 0.5%, if I'm not mistaken. Like, that's not a lot. That's 5%. I'm sorry, that's 5%. But that's not a whole lot of movement. But as it gets closer and closer to $25, this is the one day that I bought this stock. Right here. This is just that one day, and it's up 9.52%, while it's only up 4.41%. The other one is up 5.71%. So as you can see, that this is just building a case for it. And last is the GeneUS. Man, I really wish I got on this, because whenever GeneUS started to spike in the morning on Friday, I said, hey guys, in my chat room, it would be, I'm buying GeneUS. I got a position. I actually, made $1 per share off of it, but I'm like, it would be a smart idea to buy a $3 option call. Well, $3 option call, it's up and I really should have. I really should have gotten in it on it, and I didn't. But hey, it is what it is. You see, it's up, and this actually populates the option chart for you whenever you click on it. And you see, I mean, it's doing well for itself, and all these options are still on a move. So let's go back and look at Marks again. Oops, sorry. Let's go back, look at Marks, look at August 21st at mine. Well, you don't have a whole lot of, it's got a whole lot of barcoding going on just because Mark has that price action. And let's go ahead and zoom out at the 1 month chart. You see it's kind of has a downtrend. Alright? That's because it's had a whole lot of sideways action throughout this whole past month, and it's just losing interest. But as it starts to come up onto earnings, people are going to start looking at it a little bit more. And I made a case study on this, a few interviews. Y'all can look into that yourself. But I do believe Mark is going to destroy their expectations. But with that being said, I'm going to be holding my option, my $3 strike option. I spent $50 on. Let's see how much money I can make off $50. If I can turn $50 into $100, that's a 100% gain off a 50-cent move, which is not bad considering, I mean, I spent $50 on it. So that's all I have for options today. If y'all have any questions, please let me know. I'm still learning. I'm learning with you. I'm doing these as I learn new information and continuing my trading journey, just because the best way that I learn is by teaching and by showing other people what I learned through my studies and getting corrected whenever I am wrong by somebody that knows a little bit more than I do. And I absolutely love it. So with that being said, fam, thank you so much for watching. The support on this channel is phenomenal. We are growing so fast. It warms my heart. So smash that like button, hit that subscribe button, watch my other videos, and y'all be safe, fam.
Pick it up, pick it up, pick it up, pick it up. You see the drip, yeah, I'm fitted up. Hop in my car and the giddy up. Secure the bag, yeah, I get the bus. Pick it up, pick it up, pick it up.